Hi guys, welcome back. Today we are going to talk about preferred stocks and their valuation. When we are going to describe a preferred stock, we can think of it as a hybrid between debt and equity. It has some characteristics of debt as well as characteristics of common equity. Similar to debt, preferred stocks charge a fixed rate of dividends in the way that debt charges a fixed coupon interest. When it comes to voting rights, preferred stocks have very limited voting rights, similar to that of debt. However, it is also similar to equity in a way that the investors cannot legally enforce the payment of dividends. Preferred stocks legally are equity securities. Therefore, payment of dividends is not a legal obligation. Also, dividends are not expenses and therefore they are not tax deductible. And as a general rule, preferred stocks do not mature, although it is possible to have preferred stocks with a maturity date. Preferred stocks can have a cumulative feature. This is a feature that requires dividends not paid in the prior years to be paid to preferred stockholders before common share dividends are paid. So, say for example, in 1 year, the dividends were not paid to these preferred stockholders. In the following year, if there is sufficient cash for dividend payment, the preferred shareholders should be paid first, both for the previous year and the current year, before dividends can become payable to common shareholders. We call those unpaid dividends that accumulates until it is paid dividends in arrears. Preferred stock can also be participating. Participating preferred stock is a type that gives the holder the right to receive dividends equal to its usual rate plus an additional dividend based on a certain condition. There are also preferred stocks with adjustable rates. Although the general rule is that dividend rates are fixed, adjustable rate preferred stocks are those with dividend rates that are adjusted regularly. What are the pros and cons of preferred stock to the issuing company? Advantages include non-payment of dividends to preferred stocks cannot lead to bankruptcy, considering this is not a legal obligation. Issuing preferred stocks instead of common equity can prevent dilution of the shares of the existing common shareholders. And if there is no maturity, it reduces cash drain compared to debt, where during maturity, the principal or the par value should be returned to the investor. This is not necessarily true for preferred stock. The disadvantages of issuing preferred stock includes the following. The issuer cannot claim tax deduction on dividend payments. This is to be compared with debt payments of interest. Being an expense is allowed for tax deduction. One more thing, they need to be paid before common equity dividends become payable. So, no dividends can be paid to common stockholders without paying the preferred shareholders first. Now, let us proceed to the valuation of preferred stocks. Remember, the value of an asset is the present value of the future cash flows it is expected to generate. What would be the challenge for preferred stocks? Generally, preferred stocks do not have a maturity date. That is, they do not mature. As a result, we would find a stream of cash flows from year one up to infinity. We have to take the present value of all of these cash flows back to year zero should we want to know the value of each preferred share. Hence, that would be the challenge in arriving at the value. Since they do not mature, arriving at the value of the preferred stocks would require the use of perpetuity. Perpetuity is taking the present value of a stream of constant cash flows that last until forever. To arrive at the value of the preferred stocks, the formula is very simple. The value of the preferred stock is equal to the constant dividend payments divided by the required rate of return on that preferred stock. This is very simple, but it is the formula that would bring us to the present value of an infinite stream of constant cash flows. To demonstrate how this works, let us refer to the following case. Case 1. Batten Incorporated has an outstanding issue of 100 peso par perpetual preferred shares with an annual dividend rate of 8%. If the required rate of return is 10%, what is the value of the preferred stock? Again, all we have to do is to use the perpetuity formula. The value of the preferred shares is equal to the constant dividend it pays divided by the required return on such preferred share. We have value of the preferred share, 8 pesos divided by 10%. That would give you 80 pesos. What does this mean? The investor would be willing to pay 80 pesos to purchase such a preferred share. So, to demonstrate this graphically, we can imagine the following timeline. Again, generally, they do not mature. A stream of 8 pesos will be given on an annual basis, 1 year from now until forever. If the investors would want to earn 10%, then that should be the discount rate. To arrive at the present value of all of these 8 pesos from year 1 to forever, back to year 0, we need to use the perpetuity formula, and accordingly, it is 80 pesos. Take note that the value of the preferred stock here is below par. Why is this the case? Well, the fact is the required rate of return on the preferred stock is higher than the dividend rate. As such, for an investor to be motivated to purchase such a stock, the price should be low enough so that the required rate of return would be satisfied. In this case, 8 pesos is 10% of 80. So if the investor will purchase the stock at 80 pesos, every year, the investor will earn 10%. Let us go to another case where the required rate of return is lower than the dividend rate. Batten Incorporated has an outstanding issue of 100 peso par perpetual preferred shares with an annual dividend rate of 8%. If the required rate of return is 5%, what is the value of the preferred stock? Again, let us use the perpetuity formula. The value of the preferred stock is equal to D over R sub P. That is 8 divided by 5%. This time, the value of the preferred stock is 160 pesos. Again, to demonstrate this visually, we can think of the following timeline. From year 0 to infinity, a stream of 8 pesos starting year 1 will be paid that would last forever. To arrive at the present value of all of these 8 pesos, we should use the perpetuity formula at the discount rate of 5%. Accordingly, the value is 160. This time, the stock price is greater than the par. This is because the required rate of return is below the dividend rate. So even though the investor is going to pay more, it would be fine considering that 8 is 5% of 160, then the investors would be satisfied in such a setup. This is how we do the valuation of a preferred stock. Remember, the value of any asset is simply the present value of the future cash flows it is expected to generate. This will be the conclusion for our discussion on preferred stocks. As always, like, share, and subscribe.